Hello everybody, welcome to Marin Talks, my vlog where I take you through the steps of investing. In this vlog, I'm going to be talking about one of the most favored instruments of most Indians, and that is gold. Yes, you guessed it right, it's gold. There are different ways of investing in gold, and how do you decide the one best for you is what we're going to talk about in this particular video. So first off, how can you invest in gold? Well, you can go to a shop and buy gold. Secondly, you could invest in a gold ETF or you can invest in the sovereign gold bond scheme. When you buy gold in the shop, it costs you a lot because typically there's going to be these making charges, overhead charges, GST, and all these things put together work out to about 25 to 33% of the cost when you buy gold. And I think that's a very, very high amount to pay as charges at the end of the day. Then you have the option to buy a gold ETF, which basically tracks the price of gold. And of course, this is an electronic form of investment. You know, the best thing about gold ETF is that it's quite liquid. It's above 3 years. It gets long-term capital gains tax as well. And then you have the sovereign gold bond scheme. Now, these sovereign bonds are issued by the government every year in about 6 to 7 tranches. The way it works is that the price that you get at the end of it is the price of the gold. So let's say you bought it when the price of the gold was 5,000 rupees per gram. At the end of 8 years, whatever is going to be the price of the gold is what you're going to get in return, right? There is a 2.5% interest that is paid every year, and this interest is taxable. But the good thing about the SGB is that the amount that you receive on maturity is completely tax-free. So when one is to compare these options, certainly physical gold is a big no. Between ETF and the sovereign gold scheme, it really depends on how long you want to hold the investment for. If you want a more liquid investment, then go in for the ETF. If you want, something which is absolutely safe, of course, both are going to be actually absolutely safe because both are tracking the price of gold. But if you're okay to lock in your money for 8 years, then you might want to go in for the sovereign gold bond scheme. Now you also have the option to buy digital gold from the e-commerce players, and I don't recommend this at all. Because while you can buy gold at lots of 100 rupees, the point is that these companies are not regulated by the Reserve Bank. They're not audited. And finally, the price that you're going to pay actually works out higher. And in fact, another issue is that some of these companies only allow you to hold the gold for a 2 or a 3 year period, and hence not a great option to do. I would also recommend to stay away from the gold jewellery schemes which are offered by the jewelers. While you can make 11 to 12% return out there, but this is like lending your money to the jeweler, and it's very risky actually. Again, this is not regulated by the RBI because it's an advance purchase, right? So please stay away from these. So my take, do look at gold up to 15 to 20% in your portfolio, either through the gold ETF or through the sovereign gold bond scheme. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.